Welcome to the Honolulu Hawaii Housing Report. I'm Patrick O'Neill, Principal Broker at Luxury Homes International. And with us today, President of TZ Economics and Hawaii's leading real estate economist, Mr. Paul Brewbaker. How are you, Paul?
Happy holidays.
Happy holidays. Great to see you. Can't tell you how much I look forward to this every month. So truly appreciate you participating.
Great excuse to look at the numbers with you every month.
Yeah, I really enjoy it. So we're just a few weeks away from the end of the year. This has been a pretty wild year in real estate. All sorts of records have been hit, including this past month, another record. So let's just jump into the statistics. Let me pull this up real quick.
I think we tied the record for single family, but yeah.
Yeah. So these are the statistics released by the Honolulu Board of Realtors, and wanted to concentrate on something we don't normally look at, and then ask you a question and see where this goes.
Okay.
And let me just. Okay. Okay. So this is the closed sales volume year to date. You can see single family homes on the left-hand side, condos on the right.
Right.
At the current pace, we will probably close 4,500 plus or minus single family homes and over 7,000 condo sales. And I was curious to see, where does this line up with the pre-COVID numbers? So this is also January to November, pre-COVID, and then you can see the numbers where we're at right now. Obviously, we're above those numbers. And then it sort of begged the question, how does this look compared to a more historical? And if we go
let's just note how much different this year's condo performance is relative to the previous 4 years, where sales were moving in the opposite direction. And even though single family home sales are up, proportionately, they're not as much higher in 2021 than they were in the zone established from 2017 to 2018.
Yeah.
So it's really notable that not just the condos busted a move, but that they actually reversed a prior direction.
I see. Yep. Right. Yeah. 2019, we start to see things trail off a little bit.
Pre-COVID, they were trailing off.
Right.
Which is
That's right.
It was kind of an affordability story. You know, once you approach 500,000 in today's market, today's incomes, you know, the interest rates we've had the last few years, you're starting to stretch that affordability opportunity that condos typically represent.
Right. And in the recent realtor report, the major growth was really in the condos, that $400,000 to $600,000 price range.
Yeah.
Okay, so let's look at this. Now, these are going to be the annual numbers going back to 1985. Now, this year, for single family homes, we're projected to do over 4,500, somewhere in there. The last time we went over 4,000 was during the subprime bubble. And we can see the figures in there. And then let me just jump over to the condo. So again, we're going to hit probably 7,000 plus this year in annual. The last times we were over 6,000 was the Japanese bubble and the subprime bubble. Is this just an interesting statistic, or is this an indication that perhaps we are in some bubblicious territory?
Yeah, they're important benchmarks for a couple of reasons. One, we talked about this just a little earlier, but to put it on tape, there's a threshold about 5,400, 5,500 units prior and subsequent to each of the boxes you've written down, which is kind of it's like a gateway number. If you're punching up through 5,400, you're on your way to glory. And if you're punching back through in the opposite direction, you just, you know, it's like the old surfing expression, should have been here yesterday, dude. But what's extraordinary, of course, is the elevated volumes and the duration, which is at least 3 years, maybe 5, 6 or more years. And that's really important when you're sitting, as we are now, kind of 1 year into it, maybe a year and a half, asking the same question. Because one way of posing the question is this a bubble? And answering rhetorically, is it going to last 3 to 6 years? Whereas the feeling right now that I get is it feels bubblicious, or as Galen Greenspan used to say, it exhibits a certain frothiness. But it's only been about a year for condos. and only about a year and a half for single family homes. And you wonder if it has legs. That's the only thing.
And so is a definition of a bubble that it needs to be sustained over a certain period of time?
Well, I think it would be difficult to assign the same nomenclature to something that lasted 18 months that we assigned previously, just the last cycle, to something that started in 2002 and that ended in 2007 with the global financial crisis. So yeah, I don't think we're not looking at that right now. And if you go back to the 80s, remember, our 6,000 or 7,000 units is different from both the number of people and how many offshore investors there were in a Hawaii of the 1980s, where 4,000 units was actually a lot of deals. Would have been a lot in the early 80s or mid 80s.
Well, that's a good point. Right now, we also don't have our typical Asia buyers in the marketplace.
Well, they're not participating, but on the flip side, you can buy a house without even coming to Hawaii. You just go online, you buy one on your smartphone.
Well, that's you.
Well, no,
I'm not buying any homes on my smartphone.
But I mean, half of all mortgages are being underwritten online using algorithms.
Yep, that's true.
And that surely did not exist in the 1980s. So and then the snappy comeback, might be, well, maybe 6 years are being collapsed into 18 months because, right, it's all happening on this, right? We do our search on here. I went for a 3D tour of the house. I don't need to fly to plan a trip to Hawaii and spend a month of Sundays driving around with a realtor and a BMW going to see houses.
Hey, what's wrong with that?
I just go to luxuryhomesinternational.com.
That's right. Thank you.
Right. And have Patrick send me a URL for a 3D virtual. So I'm just saying, there is a different context, but it's important to benchmark. And I accept your point that there are these interesting thresholds. Let's just say 5,500 is kind of the gateway number to volume in the 6,000 and 7,000, universe transactions per year that in the past has been associated with genuinely bubblicious intervals and well-known, cycles, roller coaster cycles in housing valuations that accompanied the surge. And that is the surge in volumes that we were just looking at. You have to remember what's happening. Each time there is a surge, people are chasing the prices. They're trying to get in while the prices they're trying to get in before the prices go up. And this actually raises another important distinction between whatever you might want to call a bubble, which this might be, and what we know typically would constitute a bubble, which is the idea that a bubble is characterized by asset valuations that seemingly have detached from economic fundamentals and become unduly dominated by expectations of other investors' expectations. So if you're doing your math right now, here's some math somebody could have done in the last 18 months. They wake up, there's COVID, they hunker down, they go buy toilet paper, and then they stay at home for 3 months. And while they're staying at home for 3 months, their boss tells them, you know what? Let's never go back to the office. And they're sitting there on the 20th floor of their condo on Kuriamoku Street going, wait, I can live in Haleiwa in a bungalow and commute from there online to my old office.
And interest rates are historically low.
And interest rates are historically low because the Fed's trying to keep the economy from collapsing even further. And so there you are, summer 2020, busting a move to Haleiwa, Waialua, or Maui. I can work anywhere. So that kind of first move you'll see in the data. We'll go look at it in a second. But then the question is, so there's a fundamental thing. The COVID made it, created this massive, unplanned, involuntary experiment simultaneously across all employers, or many employers, on whether you could actually run the business without people coming to the workplace. And for some businesses, it worked like a charm. That's a fundamental change in the nature of the workplace and the commuting patterns. And so there's an interesting story. Then what happens very quickly is single family home prices move. And here's condos being abandoned on Kuriamoku Street. And all of a sudden, the relative value of a condo, relative prices matter. Absolute prices are interesting, but if they're all tending to move together as house prices do over time, then when something goes like this one starts to look really interesting. And again, as you say, at low interest rates, maybe people are going to crash that thing. And in fact, there's a whole literature out of Harvard's Housing Center, Center for Housing Studies. Professor Ed Glazer makes this counter argument to what's called the donut effect, an argument Nick Bloom at Stanford has made that says the COVID induced people to move from the urban core out to suburbs and exurbs and Zoom towns in Idaho. And Ed Glazer says, now wait a minute. Once the boomers flee from Midtown Manhattan or Kaka'ako, and those relative values, because they can live on the North Shore and don't have to commute anymore, the relative value that's still there in Kaka'ako or Kapiolani corridor is suddenly attractive to a bunch of millennials who've been waiting to bust a move, who've been trying to figure out how to move out of their parents' house or whatever the story is. And so you should see a replacement, and you're hearing that in Soho and San Francisco in the city, and maybe a little of it here now on Oahu. You can see the condos catching up on Oahu. So again, those are fundamental economic, those are associated with a list of fundamental economic factors buttressed by low interest rates, low mortgage interest rates, that make sense, but might not last for 3 to 5 or 6 years. They might be something, you got to grab that now. You got to bust the move now. This is the only time the company is going to let you go through this one-time change in remote work. And after that, we're going to go to hybrid and everything will be set. And if you're senior vice president and up, you're going to have more flexibility. Then you work in the mailroom. You still got to come to work in the mailroom. And in a real bubble, in a true bubble, things get so crazy. They get so they typically originate in good economic fundamentals that are signaling, wow, this asset class might be a real buy right now, right? Like right after 9/11 and right after the dot-com bubble burst, man, maybe a house would be right in the middle of arachnophobia. A bunch of people are waking up right in the middle of SARS, right? All this stuff is going on, 2002, 2003. And the interest rates are still low. And people go, maybe that's not a bad value. That house was worth $360,000 in 1995, and today it's only $300,000.
So it starts that way, and then as you get towards the end, now you see
now
long definition of
now you're having a conversation with your Uber driver, and he's saying,
I just had one of those conversations, so that's how I know. Sell everything. Toby's going to start developing houses.
I don't know where we are. I think it feels a little bubblicious. It's got that, like, remember fizzies when we were a kid? Drop the fizzies.
That's before my time.
Okay, anyway, Alka-Seltzer for the real old dudes. Alka-Seltzer.
I remember that.
But it doesn't quite have that same detachment from fundamentals that we associate with, at the end of the cycle, when you're trying to explain to your brother-in-law, maybe buying a house in Vegas right now I think it's a little,
right. I know. Okay, well, let's do this. Let's take a quick break. And we're going to come back, and I want to show you also the pricing and also those comparisons to our previous bubble periods. So just stand by. We'll be right back. Talk about pricing with economist Paul Brewbaker. Okay, and we're back with Paul Brewbaker. We're about to discuss pricing. And Paul, we were talking earlier about, are we in some sort of a property bubble? And we looked at the closed sales data, which seemed to correlate, or I guess, or a coincidence compared to some of the previous bubbles. And let me pull up something now on the pricing. And again, this is from the statistics just released from the Board of Realtors.
Okay.
So we're looking at a median sales price. The top numbers that are circled up there, this is just month over month. Expand that. Month over month. But the one I want to focus on right now is the year to date. And so down at the bottom left-hand side, 19.8 for single family homes. We're over 10% for condos. Assuming we're going to end the year with 20% growth in single family and something north of 10%, let's look at that in a historical context.
Well, so, we're at almost 20% for the month of November.
That's right.
For condos as well, yeah. So
yes, that's right.
So condos are catching up, so to speak.
They're catching up, right? So the annual number is going to probably go above this 10.5. Bigger data set, right? So it moves a little slower. But let's look at it from the historical perspective. There's only been 2 times that I could find when median price for single family home growth was over 20%. You can see the 2 years in the Japanese bubble period, and then there's 2 years there in the subprime.
Preceded by double-digit rates of appreciation, right? 2 years of double-digit appreciation, followed by 2 years crossing the threshold into the 20s and even 30%.
Yes, that's true.
So it's acceleration. High single digit, double digit, 20, 30, yeah.
Right. But I mean, the point is, when you get to over 20% growth, this really only happened twice in the last 35 years. And then let's take a look
that's a fact, Jack. Yep.
That's a fact, Jack. That's right. We'll look at condos. So condos, the only time we've gotten over double-digit growth, with the exception of 87, again, was Japanese bubble period and the subprime bubble. So, I mean, looking at this and putting it together with the closed sales volume, I mean, does this give more credibility to the idea that we're in some sort of a bubble?
You know, again, let's think about double digits as opposed to an arbitrary threshold, not as if double digits is no less arbitrary than 20%. But there's something about being in the double digit appreciation zone for 4, 5, 6 years, which corresponds to the sales numbers that we looked at, where we surge up over 4,500 single family and maybe over 5,500 condo transactions, as many as 7,000 per year when things are really hot. I actually had a colleague, Richard, I'm trying to remember his last name now, big dude, chief economist at City National Bank until they were acquired. And I had a bunch of economist friends who all worked for banks that were acquired. A couple of them ended up at Wells Fargo, and Richard ended up at Wells Fargo. But I can remember at the start of the subprime bubble, 2003, we looked at it in the data set. I remember sitting in a room with him where he was saying, he was adamant that a bubble happens when it's 20% appreciation, pounding the table. When 20%, it's a bubble. And I was like, you sure it's not 19.7? You know, I mean, and this is the kind of conversation.
Is this economist humor? This is the economist humor, I guess.
Yeah, it's an economist joke. But again, you look for a mix of qualities, right? Obviously, double-digit rates of appreciation, high transactions volumes as investors appear to be chasing, running after an airplane that's about to take off and hoping to jump on board to make sure they get the ride, or they don't want to miss the roller coaster, And of course, the problem with the roller coaster, they thought they were on an escalator going up at 4 or 5% per year for the rest of their lives. It'd be all good, cruise control. I live in my house. God gives me 4.5% appreciation, and I get to raise my family. And instead, you get to these moments where you're looking out the window at 25% appreciation, going, I cannot afford to miss that. And so people start to do crazy things, and which is why the roller coasters, we should always remember, have a backside.
I can't tell how many times I've heard, no, Hawaii property never goes down. It
Never
just
goes down.
plateaus and then goes
Oh,
up again. I say, no, that is not true.
and there it is in your table from 1995 to 2000 or 1999 for about 5 consecutive years. Valuations declined. Absolutely. So somebody who got on the train in 1996 and 1995 and bought a $430,000 condo, and wait a minute, that's an average single family home price. Somebody who bought a $175,000, $180,000 condo, $190,000 condo in the early 90s ending up owning a $125,000 condo by the time 9/11 came. And man, would it suck to be somebody who lost, what's the cumulative loss in value? 30%? You know what I mean? That's harsh. So much for the, oh, I went up 20% for 2 years. Yeah, and then you went down 30% for the next 5. So, easy come, easy go. In fact, I think if you look carefully, there are if you adjust for inflation, condo prices by 2000 were actually lower than they were in 1980.
Wow.
It's something like that. I can remember Mike Sklar's talking about that. So cash would have been a better investment than a condo in Hawaii for the 20 years if you got on the train at the wrong time.
Right. Bought at the peak, right? And
bought at the peak.
Yeah, right.
And of course, for every person that buys at the trough and buys at the peak, there's some guy selling at the trough.
That's
and
right.
Buying at the peak. The transaction
That's the way it
has
works.
2 sides. That's the way it works. And what we see over time is that in the long run, it is an escalator, but these prices, there's the bubbles, move around that cycle. And whether it's single family or condos, and there's that moment where the condos dipped so low by 2000 that if you take into account the inflation between 1980 and 2000, you were probably worse off or no better off. Now, these data cut off a couple of years ago, pre-COVID. And we were talking about this earlier. It's just nobody wants to see the long-term data right now because everybody's focused on what happened in the last, now it's Omicron variant. And, and 3 months ago it was Delta variant. And by the way, not every place has the same roller coaster. Here's the roller coaster in Nevada. And Nevada, from 1980 to the subprime bubble for 20 years, was steady as she goes at whatever. I don't remember what that rate of appreciation was, but it was bankable. Oh, there it is down in the footnote, 3.25%. Like a savings account, except you get to live in a house and you don't get to live in a savings account. That was the pitch for houses in places like Nevada that, well, it's a desert, but it's inexpensive and you can work in a casino. And then, of course, when the subprime bubble came, the unwinding of the bubble, the crash and burn at the other end of the roller coaster ride was almost symmetric with respect. And all prices did eventually, if you waited 10 years, was get back on the same escalator.
On the trend.
And that's happened here in Hawaii.
So where are we now? Does this data include?
Here's where we are now. This is through November. So this is including data up through last week. And what we've seen is that pre-COVID valuations had kind of fizzled out. You want to talk a bubble, right? This flat. Somebody left the soda out with the cap off, and now the Coke is flat.
In 2019, the whole market seemed to be poised for this correction after being the longest expansion ever.
People started talking about recession. There was concern that if the Fed was going to normalize interest rates, it might, and that the trade war and the blah, blah, blah. And then came COVID. And then people at first were like, oh, now we're toast. But of course, exactly the opposite happened. And liftoff came earliest in single family homes because of the fundamentals we talked about. A change in preferences away from attached dwellings where there's more risk of infectious disease acquisition, living in the same building, riding the same elevators as other people, and towards detached dwellings where many people now can work remotely. Of course, they could in a condo, but they still have to ride the elevator to their unit. And so single families homes move first, and then condos this year, as we've seen in the data from the board, last 6 months, last 9 months have caught up with a vengeance. Now notice at the peak here, those numbers aren't that much different for the last 4, 5, 6 months. That is, single family homes are starting to lose a bit of traction. These are October data. So November went back up, that zig right there, reversed the zag in October. But Maui's lost its luster on the single family space, and Kauai's lost its mojo a little bit, right? All these markets punched out to the upper bound or just over the upper bound of the bandwidth of the 20 teens escalator. And that's why we're talking about bubble, because once you punch out of the zone, wow, that looks like a bubble. That looks like those old roller coasters. And then we ask the question, well, is it going to stay like this? Is it already over? Did all the people who were able to work remotely at Google, did they already move to Maui, and are they done? And if so, they're done. That's it. Nobody else needs to move. And, the politics of county council membership will change permanently by the new batch of Californians that just moved to Kauai. But you can see in each of these cases, I've put in the regressions for the single family homes. The thing to note about condos is they haven't been as robust until just recently. In each case, there's a pattern where condos were catching up. And here's a way to think about it. Ordinarily, a single family home price on Oahu is about 1.9 times the median condo price. The median single family home price is not quite 2 times, but 1.9 times on average the median condo price, plus or minus 0.2%. So you say, the range is 1.75 to 2.05, but the average is 1.9.
And I remember this maybe a couple of years ago when you did one of your presentations at Waialae Country Club. You showed the correlation of single family and condo pricing, always been riding the same tide, up and down, up and down, up and down.
That's true for a number of things. We'll look at one of them in just a second. Here, what we're saying is absolutely they move together. The ratio is 1.9, right? So they move equiproportionately. If one goes up 20%, then the other goes up 20%. And what was so odd for the first 6 months to a year after COVID is that the single family home prices were moving, but the condos weren't as fast. And as of November, we just looked at the data, as of November, condos are up 19%, single family homes up 20%. If condos continue to do this catch up, then that ratio, which you see descending now, will go back to 1.9. The condos are catching up from behind. And we see this in another indicator. I think the one you're recalling is the inventory numbers. These are months of inventory remaining, but you can see how tight they've always been. And this post-COVID window where single family home inventories shriveled up as people swarmed to that market segment to buy a detached dwelling, created this very odd, very unusual gap between an inventory in the condo market that was still piling up. Now it's caught up, and we would say, well, it's still a little different. But I mean, at 1 month of inventory versus 1.5 months of inventory, I don't know if you're really, is that a material difference? When the single family home market, is showing 2 months of inventory, but the condo inventory is showing 4 months of inventory, that's a big difference.
Which was the case.
Which was the case 1 year ago.
Yeah, right, exactly. Yeah. Well, let's take a quick break, and we come back. Let's take a little look at that as far as what the inventory looks like. And there was another record set this past month. So stand by. We'll be right back with economist Paul Brewbaker. Okay, and we're back with economist Paul Brewbaker. Paul, let's take a look at some more of the statistics that came out. And let me pull this up here. Okay, so again, from the Honolulu Board of Realtors, these were the statistics from last month. And wanted to look at this. So this is median days on market. Condo set a brand new record of 9 days. I'm sorry, I blacked out the other ones that were there, but
that's amazing. 9 days. That's like,
it's incredible.
Yeah,
it's unreal. I mean, certainly a function of supply and demand. I think we'll talk about that in a moment.
If it was 9 days to Christmas, you'd be freaking out right now. Wait, what? 9 days?
That's right. That's right. Yeah, Christmas Eve, I'm usually at Long's doing my shopping. So, yeah, and I have one of my agents just called me, and she sounded a bit of a panic. I don't know what to do. I need to figure out. I said, "What's happening?" She said, "I've had this house on the market for 2 weeks, and it's not sold yet." It's okay. All right. But I mean, I like where we've gone to, but it really truly is incredible. And I have to point out again, when we're looking at this 9 days, and we're looking at this price growth in condo market, it really is this lower end group. You know, and you and I were talking about this before. They're a high end, certainly the Howard Hughes and what they're selling down there, the new product is still flying off the shelf. Incredible.
Beautiful, high quality.
Fantastic.
We all wish we could afford, but
yeah, that's right. Really great. But a lot of this growth that we're seeing is in that 400,000 to 600,000 range. That's really driving a lot of this volume. Let's take a look at one other statistic here. This is the properties sold above list price. It's almost boring now, but these are incredible numbers. You know, to think 61% of all the homes sell above list price and over 40% on the condos. And this is sort of a function of that, but I cannot remember ever seeing this in a report before. This is percentage of properties that have sold over list price or percentage of the original list price. Condos at 100%. I mean, I know that's an average or a median of it all, but it's just fascinating to me.
Yeah, no realtor has ever said this sentence to a client. I guarantee you get 100% of what we list. And there you go.
And don't start a new trend either.
Don't ever say that.
That's right. That's right. Well, now you can say we'll get about 102%.
There you go. The odds are 50-50, 60-40. I mean, 60% of single family and 40% of condos are selling above the median price. What's the average of that? 50-50. So,
and what do you see as far as inventory? You know, and of course we have this tremendous volume right now. These closed sales volume. Is inventory trending up? Are we trending down?
Well, let's use the board's own data. I mean, think of it in terms of velocity. You're looking at listings that have been going sideways. They were the same level. You know, there's seasonal variation, but they're basically people are listing their houses at about the same rate, single family condo, as they were pre-COVID, post-COVID, no big diff. But then because of this tremendous velocity, you have the inventory just shrinking and shrinking and shrinking.
Wow.
So now the same amount, now even higher sales volumes are going, you know, people are going searching for an inventory that's shriveled and to which new units are not being added at any higher pace than was the case in the past. So it's just like this incredible shrinking opportunity in a world where the interest rates are still as low as you'll ever see them, and in which, as the perceived threat of the novel coronavirus slowly recedes, and we can look forward to an economy that'll probably be better in the next 2 years than it was in the last two, more investors are reassured about their risk exposure and are willing to, make this bet, which is it's a big bet, right? Buying a house is a big bet. And there's a whole cohort of millennials that are out there for the first time buying in the space you're talking about, this 400 to 600,000, they're trying to make the stretch into their first 1 or 2 bedroom condo in a market with a median of 500,000.
Yeah. So looking at that data you just pulled up, so there really, it's a stable amount of new listings are coming on the market, but the volume has swollen. Yeah. So supply and demand, it has to have more upward pressure on pricing.
Well, and that's why the pricing pressure is there, and that's why the velocity is speeding up, and that's why the number of days between listing and sale is shrinking because, as you say, the supply, the organic supply, where does that come from? People move, they get divorced, their kids go off to college, it's just life. That hasn't fundamentally changed pre or post COVID. It's a little surprising because, Hawaii's economy took kind of a hammering and hasn't come back yet. And yet we don't really see, and we know that the population has been shrinking on Oahu because of net outmigration. I mean, there's some deep issues, longer term issues about the viability of the urban Honolulu, economy that have weighed on some people. And there are other factors like aging, where it's challenging to retire in Hawaii, not maybe as much in some places where people are moving in the Intermountain West and Southwest and so on. So all of those factors are still at play, and sort of the drip, drip, drip of people listing their homes because of life changes and so on is being overwhelmed by this sudden surge in demand, particularly this year or the last 6 months on the condo side of the market, and leaving us asking this question: is it a bubble? And the part of the answer, to go back to what we talked about before, has to do with whether the motivation is, are they buying a condo because they heard their Uber driver say that they heard their fast casual hostess say that she heard something, right? Is it driven by the buzz on something they saw on TikTok that said, you got to buy one now or you're going to miss the boat? Or is it being driven by fundamental things like, I just got a new job, I just got we got a promotion, or I built up some savings, I got lucky in Bitcoin or whatever, I banked my stimulus check, and I now have just enough to get into the to a number I can convince my parents to help me with the down payment. I mean, all of those stories are unfolding before us right now, and usually those are fundamental stories. A true bubble is one in which none of that stuff matters, and everybody's just in this mad, crazy scramble. Like the movie, it's a mad, 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 mad world.
Right.
Where you guys are completely irrational. What are you doing?
Right.
That's a bubble.
And I know you've said this before. So the condo inventory that's being added to the market, we've got a pretty good mix actually in the Howard Hughes. There's high to low. There's everything in between.
Yeah,
the Kapilani corridor. Yeah, we're
yeah.
delivering all sorts of product. If I recall, you've said you've said multiple
product,
times we are issuing the same amount of building permits that we did during World War II. Is that still the case? Are we still in this really?
Technically, World War II was 0, but I just got through sending that to somebody who was asking for those data. We're producing on Oahu right now less than we did in the late 1920s.
I see. Okay. All right. Okay.
So, right, World War II, they just shut down. So technically that was 0. But there were 1,200 housing units authorized by building permit last year. On Oahu, 1,218, I think it is. And there were easily 1,500 units per year. By the way, the average household size in the 1920s was 5.5 persons. Today it's 2.95, call it 3. So 5.5 people per house versus 3 persons per household per house. And the average size of a new house in the 1920s was a little over 1,000 square feet. And today it's a little over 2,300 square feet. So bigger houses, fewer people. And my question to all of us here in Hawaii is, I thought the lyrics of the song went, we'll build a bungalow big enough for two, my honey, big enough for two, walla, walla, walla. And when we're married, how happy we'll be underneath the bamboo tree, right? Right, you can go.
Excellent. By the way,
you can go to the Columbia University Library and download a copy of Lewis and Cook Homes in Hawaii catalog from the 1920s. It's just wonderful to leaf through these bungalows ranging from 700 to about 1,800 square feet, And you see these houses all over Honolulu, right? They're all over Moiliili, down in
Right.
Waikiki, in the back of the
Right.
concrete jungle, and
Yes.
here and there in Kaimuki and everywhere. Wonderful sort of craftsman-inspired bungalows that were apropos to the times, in the sense that people weren't as wealthy as they are today. People had larger families than they do today. But it's a reminder that we kind of build too much house. And maybe if we built more of them and they weren't so big, there wouldn't be so many people feeling like they need to just grasp at whatever is available.
And so
And
and going to this idea of the building permits and the numbers that we're
yeah,
adding, meaning it really still is not keeping up with population growth. There's not a lot. There is supply being added, but nothing that
yes.
really is going to affect
And
the market in the short term.
Let's remember, new houses are bitching. You know what I mean? You look at what's being built by D.R. Horton out at Ho'opili, or by Castle and Cook up at Koa Ridge. Oh yeah, bro. You just mentioned all the condos in Kakago and whatnot. Yeah,
Right.
the new houses are always the nice ones, right? What's affordable housing? Affordable housing is always the old junk housing. Everywhere on the planet, the first apartment you move into is an old junk apartment.
That's the affordable housing.
That's the affordable housing. That's
Right.
the definition of affordable housing.
Yes.
And the more new housing you build, the more old housing is going to be uncompetitive, less competitive, shall we say, under pressure. And here's the dark side of what we're talking about. Honolulu had a window beginning in about 1975 and ending in 2015 to do something about it. And Honolulu went in the opposite direction. It built less housing, not more housing, which is why by the end of the 20-teens, we were building less than we were building at the end of the 1920s without computers. And they slung together a nice little bungalow for two with a nail and a hammer, not a hammer gun. I'm talking whack, whack, whack.
And we see it even with entitled housing developments like the Castle and Cook. They're still held up for 15 years.
They're hung up 15, 20, 30 years.
Yeah, I know.
And then 20, 30, 20, 25 years to build 3,500 units.
I know.
I know. If you take everything Castle and Cook will ever build at Koa Ridge and everything D.R. Horton ever will build at Ho'opili and add them together, that's less than was built on Oahu the year I graduated from Kailo High School.
How about that? That was in the 1920s?
Yeah, that was in 1938.
That's right.
And so right before the war. I'm just saying,
it's
not that we can't do it. It's something happened. But wait, it gets worse. Why did I say the window closed in 2015? Because we didn't do it, people have been leaving Oahu since 2016 in numbers so large that they swamp all other sources of population growth. So the population on Oahu has declined, the population statewide, I know the statewide number, and it's all Oahu because some people are still moving to the neighbor islands, 2 guys from California. The population declined by 30,000 between 2016 and 2020, for which we have an intercensional estimate. We'll get the decennial census estimate next year. Meanwhile, we'll have an intercensional estimate for this year by the end of December. It's December, so wait a couple weeks. It will probably show that for 5 straight years, the population on Oahu has declined by amounts I'm going to guess are in the neighborhood of 35 to 40,000 persons. But wait, if you look at what the state was projecting for population growth only 3 years ago, and what all the developers were using to do their pro formas and make their plans and so on, what we're all counting on to exist as realtors or economists in a housing market like Honolulu's, we're 60,000 to 65,000 persons below where we would have been had the forecast been realized, as opposed to having this exodus. Well, what happens when, say, 35,000 people leave the island, or what happens when the population declines by 65,000 relative to what we thought would be the housing need in the early 2020s? I'll tell you what, at 3 persons per house, that's 10 or 20,000 liberated existing houses. 30,000, 60,000 people left. That means 10 or 20,000 housing units just opened up, or the equivalent, at 3 persons per unit.
Yeah. Yeah.
And wait a minute, we're all in a feeding frenzy to buy the next condo when there's an empty house over there. You know why? Old man, what's his name? Brother died, bro, last year. The parents haven't figured out what to do with the house. And you know those guys that were living on, bro, they moved to Ninth Island, bro. He's in Las Vegas. They still don't know what they're going to do. They're still hanging on to the house. Oh yeah, we can keep house in Hawaii. Yeah. Right. And we're right in the middle of this thing that's happening, and then COVID drops in on top of it to make it even more confusing. And the question for the 2020s and for the next generation from now through mid 21st century is, are we Detroit? Or are we Boise? Are we the city 30 years from now we'll look back on and say, yeah, and then everybody left and we scraped the home sites because of the derelict structures? Or are we Boise or Salt Lake City or Las Vegas or Phoenix? The states, 4 states with the highest population growth in recent years: Idaho, Utah, Nevada, Arizona. Followed by Texas, Alabama, South Carolina, right? That's where people are moving.
Well, and I can answer the one question. We're definitely not Detroit.
Yes.
So don't worry about that. Sorry, Detroit.
No, I'm just saying,
I understand.
You don't want to end up in that place.
No, I understand.
And I only say that is because about the time you were born, I was teaching college in Milwaukee, and I was like, wait, it's called the Milwaukee Brewers and all the breweries just closed? What does that tell you? And they're still the Milwaukee Brewers, but the largest selling beer in the world in 1960, which was Schlitz.
Malt liquor.
By 1980, Schlitz was gone, Pabst was gone, Blatz beer was gone, and that's the year I moved to Milwaukee. Let me tell you, it's a weird to show up in a city where everybody just closed their factory except one guy, Miller Beer. And so you don't want to end up, and Pittsburgh and Detroit and Gary, Indiana, and Milwaukee Cleveland have been fighting that fight for 30 years.
And I mean, we don't have the production-based economy. We're a little bit different if we just kind of get ourselves on this right path, you know. But
well, we've got to figure out how to manage tourism so that people aren't hating on it so hard.
I know. It's great. Well, Paul, listen, I think we've about run out of time. I just want to tell you how much I really, truly look forward to this every month. And next month will be the annual recap, which will be really interesting to be able to look back on the whole year together. So I just want to say thanks for joining us, everyone. Stay safe. Be kind to your realtor. And we'll see you next month.
Mele Kalikimaka, everybody.
All right, Paul. See you.